Hello and welcome to the Tellone Financial Podcast, where we help you secure your financial future one smart decision at a time. I'm your host, Dean Tellone, and I'm glad you're joining us. This podcast is dedicated to making complex financial topics easy to understand so that you can make informed choices about your money. Whether you're a retiree looking to preserve your nest egg, a busy professional building wealth, a business owner planning your next steps, or anyone striving for financial security, this show is for you. Our goal is to share practical insights and expert guidance in a conversational, friendly tone. We want you to feel confident and empowered on your financial journey. In each episode, we'll dive into a specific topic in personal finance and wealth management, drawing on real industry examples and proven strategies. No hype, no confusing jargon, just clear, actionable advice. Together, we'll demystify financial planning so you can make smart decisions for a secure and fulfilling future. So once again, welcome to the Tellone Financial Podcast. Let's get started. Now let's dive into today's topic. Episode 1, Retirement Planning, Securing Your Future with Smart Financial Decisions. Dean, host. Are you confident that your retirement savings will let you live the life you want when you stop working? For many people, that question is a source of anxiety. Retirement can feel both exciting and daunting. It's a time to enjoy the fruits of your labor, but it also means shifting from earning a paycheck to relying on the wealth you've built. Planning for that transition is one of the most important financial steps you can take in life. In fact, studies show that almost half of American households have no retirement savings at all, which is a scary statistic. We're here to make sure you're not part of that statistic and that you enter retirement with confidence. Today, we're talking about retirement planning and how smart financial decisions made now can secure your future. We'll break down key principles of retirement planning in simple terms and share real examples to illustrate how they work. By the end of this episode, you'll have a clearer idea of how to plan for a comfortable, worry-free retirement. Why retirement planning is so important. Let's start with the basics. Why is retirement planning such a big deal? The short answer is that people are living longer, and retirement can easily span 20, 30, or even more than 30 years. Imagine finishing your career at 65 and potentially having 2 or 3 decades of life ahead. That's a lot of years to fund. You want those years to be enjoyable, not filled with financial stress. A solid retirement plan acts like a safety net, ensuring you have the income to maintain your lifestyle and handle unexpected expenses when you're no longer working full-time. Another reason planning is crucial. Once you retire, your paycheck stops, but the bills don't. You still need to pay for housing, food, utilities, healthcare, maybe travel and hobbies. And with inflation, the cost of these things tends to rise over time. Think about it. Something that costs $1,000 today might cost $2,000 or more in 25 years due to inflation. Without a plan, it's easy to outlive your savings or find yourself cutting back on things you enjoy. We don't want that for you. Retirement should be a reward, not a struggle. It's also important because Social Security, while helpful, isn't likely to cover everything. On average, Social Security benefits replace only around 40% of a typical worker's pre-retirement income. Most folks need about 70 to 80% of their pre-retirement income or more to live comfortably in retirement. That means your personal savings and investments often have to cover the gap. If you're a business owner or a professional with a higher income, you might find Social Security is an even smaller fraction of what you'll need. So the bulk of your retirement security will come from what you plan and save in advance. Simply put, the sooner and more thoughtfully you plan, the better your chances of achieving the retirement lifestyle you want. Real-world events have shown why preparation matters. Think of the 2008 financial crisis or even the recent pandemic downturn. People who had a solid plan and diverse investments were better able to weather those storms. In contrast, those who didn't have a plan or who put all their eggs in one basket faced much tougher situations. A classic example often cited in our industry is what happened to Enron employees in the early 2000s. Many had nearly all of their retirement savings invested in Enron's company stock. When Enron collapsed, those employees lost most of their retirement nest egg overnight. It was a harsh lesson that diversification and planning are not optional. They're necessary to protect your future. We'll talk more about diversification soon, but keep that story in mind as we go through today's topic. The bottom line is, retirement planning is about peace of mind. It's about knowing that you've set yourself up to handle whatever comes next so you can enjoy your later years. Now that we've covered the why, let's move on to the how. How do you actually plan for a secure retirement? What smart financial decisions can you start making right now? Start early. The power of compounding. One of the smartest financial decisions you can make for retirement is to start saving and investing as early as possible. You might have heard the phrase, time in the market beats timing the market. What that means is the earlier you start, the more time your money has to grow, and that growth can be exponential thanks to the power of compound interest. Compound interest is a simple but powerful concept. It means you earn interest on your money, and then you earn interest on your interest, and so on. Over many years, this can turn even small regular savings into a huge sum. Let me illustrate with a real example. Suppose at age 25, you start putting aside $200 a month into a retirement investment account, and let's say it grows at an average 7% annual return. If you do that consistently until age 65, you could end up with around $600,000 by the time you retire. Now imagine someone else who waits until 35 to start, investing the same $200 a month at 7%. By age 65, they might end up with roughly $270,000. They started just 10 years later, contributed the same monthly amount, but ended up with less than half the money. That's the power of starting early. Those extra years of compounding make a dramatic difference in your outcome. Now you might be thinking, well, that ship has sailed. I'm not 25 or 35 anymore. If you're getting a later start, don't panic. It's never too late to start planning and saving for retirement. Yes, starting earlier is better, but starting later is still far better than not starting at all. In fact, if you're 50 or older, there are special provisions called catch-up contributions that let you put more money into retirement accounts like 401ks and IRAs each year. These are designed to help people who got a late start to accelerate their savings. For example, in many workplace retirement plans, people over 50 can contribute a few $1,000s extra beyond the normal limit. This can really boost your nest egg in the final stretch of your career. The key is to begin now and save aggressively. You may need to save a higher percentage of your income if retirement is not far off. But every dollar you put to work now will be much appreciated later. One more thing about compounding. It rewards consistency. Even if you can only save a small amount, saving something regularly is better than saving nothing at all. Automatic contributions can be a lifesaver here. For instance, automatically contributing a part of each paycheck into a retirement account. Over time, you might hardly notice those contributions leaving your checking account, but you will definitely notice the growth when you look at your retirement account balance years down the road. Set it, forget it, and let compounding do the heavy lifting. Define your retirement goals and needs. Another smart step in retirement planning is figuring out how much money you'll actually need in retirement. It's hard to hit a target if you haven't defined it. Everyone's retirement looks a little different. Some folks dream of traveling the world. Others might plan to downsize their home and spend more time with family. Others might want to start a small hobby business. So, take some time to imagine your ideal retirement. Ask yourself questions like, when do I want to retire? What do I want my days to look like? What expenses will I have? A common guideline that financial planners use is the 70 to 80% rule. This says that you should aim to have about 70% to 80% of your pre-retirement annual income available each year in retirement. The idea is that some expenses, like commuting costs or work clothes, may go down when you retire, but other expenses, like healthcare, travel, or hobbies, might go up. For example, if you're earning $100,000 a year before retirement, a rough goal might be to have $70,000 to $80,000 per year available to spend in retirement. This can come from a combination of sources: your investments, Social Security benefits, pensions, if you have one, rental income, etc. It's a ballpark figure. Some people might need more, some less, depending on lifestyle and health, but it's a useful starting point to gauge the size of the nest egg you should aim for. Let's bring that to life with a quick example. Imagine you currently earn about $60,000 a year. Using the 70 to 80% guideline, you might estimate needing roughly $42,000 to $48,000 a year in retirement to maintain a similar standard of living. If Social Security will provide, say, $20,000 of that per year, just picking a rough number, then the rest, around $22,000 to $28,000 per year, would likely need to come from your savings and investments. If you plan a retirement of 25 years, that means you'd need to save enough to withdraw on the order of $25,000 a year for 25 years, plus growth and some cushion for inflation. This is a simplified way to look at it, but it highlights that saving for retirement essentially means saving up your own paycheck replacement. There are many retirement calculators available, some on sites like NerdWallet or financial planning websites, that can help you plug in your own numbers, your age, your savings so far, your desired retirement age and income, to get a more personalized target. The key point is, be intentional about setting a retirement goal. It gives you something concrete to work toward and measure your progress against. Without a goal, it's easy to either save too little and get a nasty surprise when you're 65, or even to oversave at the expense of enjoying life now. We want balance. Plan enough so you're secure, but also live your life. Good planning can help you find that balance. Maximize retirement accounts and free money. Once you know you need to save, the next question is where to put those savings. This is where retirement accounts come in. Things like employer-sponsored plans, for example, 401k, 403b, or thrift savings plan for government workers, and individual retirement accounts, traditional or Roth IRAs. Retirement accounts are powerful tools because they offer tax advantages that help your money grow faster. In a traditional 401k or IRA, for instance, the money you contribute can often be deducted from your current income, which lowers your taxes today, and it grows tax deferred until you withdraw it in retirement. In a Roth account, you contribute post-tax money, but then it grows tax-free, and you can withdraw it tax-free later. Either way, you're getting a tax break, which effectively means more of your money is compounding over time instead of going to Uncle Sam right now. That can make a huge difference over decades. If your employer offers a retirement plan, make sure you take full advantage of it, especially if they offer a matching contribution. Employer matching is essentially free money on the table. For example, your company might say, we'll match 50% of your contributions up to 6% of your salary. If you contribute that 6%, they add an extra 3%, half of it on top, just as a bonus for saving for yourself. Not contributing enough to get the full match is like leaving part of your salary uncollected. Surprisingly, a lot of workers do leave this free money behind. Don't let that be you. If you can, contribute at least enough to get the full employer match. It's one of the smartest immediate returns on investment you can find. For those who are self-employed or business owners, you have options too. There are special retirement accounts like SEP IRAs, simple IRAs, or solo 401ks that let business owners and freelancers save substantial amounts for retirement, often with great tax benefits. If you own a business, also consider your end game. Do you plan to sell the business or pass it on as part of your retirement strategy? The value you build in your business could be a significant part of your retirement funding, but it takes planning to extract that value. For instance, planning a business sale or succession in advance to ensure you get the retirement income you expect. This is an area where working closely with financial and legal advisors can really pay off to make sure your business success translates into retirement security. No matter what path you're on, corporate employee, government worker, entrepreneur, or gig economy free agent, there is a retirement plan that fits your situation. The main thing is to use them. Shift your mindset to treat saving for retirement as paying yourself first. When you budget, think of your retirement contribution as a must-pay bill, except this bill is actually building your future wealth. If you prioritize it, you'll be amazed how your retirement accounts can grow over time. Invest wisely, diversification, and risk management. Saving money is one side of the equation. Investing it wisely is the other. Stashing cash under a mattress won't get you to a comfortable retirement. Inflation will eat away its value. So, we need to invest our savings in assets that grow, like stocks, bonds, real estate, or other vehicles. But with investing comes risk, which is why smart risk management and diversification are key parts of retirement planning. Diversification is a term you'll hear a lot. In plain English, it means don't put all your eggs in one basket. A diversified portfolio spreads your money across different types of investments. For example, a mix of stocks, bonds, and maybe other assets like real estate or funds, so that you're not overly reliant on any one thing. We mentioned earlier the Enron example. Those employees had almost all their retirement money in one company's stock. That's an extreme case of lack of diversification. A well-diversified retirement portfolio might include hundreds or even thousands of different companies' stocks if you invest in broad index funds or mutual funds, a selection of bonds, and perhaps some cash or cash equivalents. The idea is that if any one investment performs poorly, it's only a small portion of your overall nest egg, and other investments can help cushion the blow. Diversification is your best defense against the ups and downs of any single investment. Hand in hand with diversification is asset allocation, which is just a fancy way of saying how you split your money among different asset types, like stocks versus bonds. A smart strategy is to tailor your asset allocation to your age and risk tolerance. When you're younger and have a long time until retirement, you can invest more aggressively. Typically, this means a higher percentage in stocks or stock funds, which tend to have higher volatility but also higher growth potential. The reason young investors can afford to be aggressive is that if the market has a bad year, or even a bad few years, there's time to recover before you need the money. Historically, the stock market has had many ups and downs, but over long periods, 20 to 30 years, it has generally trended up. As you get closer to retirement, it usually makes sense to dial down the risk a bit. This often means shifting gradually into more stable investments, like bonds or other fixed income assets, which can provide steady interest payments and are less volatile than stocks. By the time you're near retirement age, you don't want a huge market swing to suddenly cut your savings in half right when you need them. So, a common approach is something like, maybe in your 20s and 30s, you might have 80 to 90% in stocks. In your 40s and 50s, perhaps closer to 60 to 70% stocks, and the rest in bonds. And in your 60s and 70s, perhaps closer to 40 to 50% stocks, and the rest in bonds. 60s, you might reduce risk further, perhaps a 50-50 mix or even more tilted to bonds and cash for safety. Individual percentages will vary depending on personal preference and situation. The idea is to balance growth and security. You want enough growth so your money keeps up with inflation and lasts through your retirement, but also enough stability so a market crash won't derail your plans at the last minute. If this sounds complicated, the good news is there are tools to make it easier. Target date retirement funds are one great option. These are mutual funds that automatically adjust the asset mix for you as you age. For example, if you plan to retire around 2035, you could invest in a 2035 target date fund. That fund might be heavily in stocks today, but over the next decade, it will automatically shift to a more conservative mix by 2035. It's a set it and forget it approach to appropriate risk levels. Another approach is to seek professional financial advice. A financial planner can help design an investment portfolio tailored to your goals and comfort level. The team at Tellone Financial Services, for instance, spends a lot of time helping clients find that right balance, aligning investments with the client's retirement timeline and risk tolerance. The key point here is invest your money wisely and strategically. Don't just save, make the money work for you, but do it in a way that you can sleep at night without worrying about every market fluctuation. Before we move on, one more smart decision in investing. Avoid trying to time the market or make emotional decisions. It's natural to feel anxious when markets swing. When you hear news of a downturn or a recession, the knee-jerk reaction might be to pull out of investments to be safe. On the flip side, when the market is booming, you might feel tempted to throw more money into hot stocks. However, emotional investing often leads to buying high and selling low, the exact opposite of what you want. A powerful example came during the 2008 to 2009 financial crisis. The stock market fell by roughly 50%. Some investors panicked and sold everything, locking in their losses. Yet, within a few years, the market had recovered and even reached new highs. Those who stayed the course or kept investing through the downturn were in a much better position by 2013 than those who got out during the panic. The lesson is to stick to your long-term plan. Markets will go up and down, but if you have a diversified portfolio and a sound strategy, giving into fear or greed will usually hurt you more than help you. If you find it hard to manage this emotionally, that's again where an advisor or an automated investing plan can help keep you disciplined. Remember, retirement planning is a marathon, not a sprint. Consistency and patience often win the race. Plan for inflation, healthcare, and longevity. We've covered saving and investing strategies. Now let's talk about planning for the realities of retirement life, namely the costs of healthcare, the impact of inflation, and the fact that you might live a very long time, which is a good thing, but it requires more financial resources. Smart retirement planning means anticipating these factors so they don't catch you off guard. First, inflation. We touched on this earlier, but it bears repeating. Prices tend to rise over time. At a modest 3% inflation rate, the cost of living will double in about 24 years. So if you retire at 60, By the time you're 84, everything might cost twice what it did at the start of your retirement. This means that even in retirement, your investments need to continue working for you to some extent. It's common for retirees to keep a portion of their portfolio in growth-oriented investments, like stocks or stock funds, specifically to help combat inflation over a retirement that could span decades. The smart decision here is not to play it too safe by going 100% into cash or low-yield bonds the moment you retire. While you do want safety, you also want to ensure your money maintains its purchasing power. The challenge is finding the right balance, enough growth to beat inflation, enough stability to preserve capital. It might sound like walking a tightrope, but with a diversified approach and possibly the help of an advisor, you can manage this balance. The key takeaway is plan for rising costs. If your plan works only with today's prices, it might fall apart in 15 years unless you include some growth. Next, healthcare costs. Healthcare is often the elephant in the room for retirement planning because it can be a very large expense and it's hard to predict. As we age, medical costs tend to increase. You'll likely have Medicare after 65 in the US, but Medicare doesn't cover everything. There are premiums, co-pays, medications, and services like dental or vision that often aren't fully covered, not to mention the possibility of needing long-term care or assisted living at some point, which can be extremely expensive. To give a sense of scale, one well-known study by Fidelity estimated that a typical 65-year-old couple retiring now might need on the order of $300,000 or more to cover their healthcare expenses through retirement. That number can be startling, but the point is to expect significant health-related expenses and include them in your planning. What smart decisions can help here? For one, if you're still a few years away from retirement, consider contributing to a health savings account, HSA, if you have access to one through a high-deductible health plan. HSAs are another great tax-advantaged savings vehicle, and the money can be used tax-free for medical expenses at any age. And after 65, it can be used for non-medical expenses too, though those withdrawals would be taxed like an IRA. It's like a sidecar to your retirement plan specifically for healthcare. Also, as you approach retirement, get to know what Medicare covers and what it doesn't, and look into supplemental insurance, Medigap plans, or Medicare Advantage to limit your out-of-pocket exposure. If you have a family history of needing long-term care, you might explore long-term care insurance in your 50s or early 60s, which can help pay for nursing home or in-home care if you ever need it. The options can be complex, but ignoring healthcare costs could derail an otherwise good retirement plan. The smart move is to plan early for healthcare, just as diligently as you plan for your basic living expenses. Now, let's talk longevity. It's a blessing that many of us will live longer, healthier lives. But from a finance perspective, longevity means your money has to last longer. One of the biggest fears retirees have is outliving their money, and rightly so. If you retire at 62 and live to 95, that's 33 years of retirement to fund. So how do we make sure our money lasts? We already mentioned not drawing it down too fast. One popular guideline is the 4% rule, which suggests that if you withdraw about 4% of your retirement portfolio in the first year of retirement and then adjust that amount for inflation each year, your money could last 30 years or more. This is not a one-size-fits-all rule, but it's a helpful starting point. For example, if you have $1 million saved, 4% of that is $40,000. So in the first year of retirement, you'd aim to withdraw $40,000 to live on, in addition to any other income like Social Security, then maybe $41,200 the next year if inflation was 3%, and so on. Studies have shown that with a balanced portfolio, this approach had a high success rate historically for 30-year retirements. Some recent thinking suggests being a bit more conservative, maybe 3.5% initial withdrawal, given lower interest rates today, but the concept remains. Have a plan for sustainable withdrawals so you don't run dry. Another smart idea is to diversify your retirement income. Instead of relying solely on drawing down investments, consider other income streams. Social Security is one, and you have some control over it. For instance, delaying Social Security benefits increases your monthly check. Waiting until age 70 or 62 can significantly boost your benefit. If you enjoy working or need additional income, some people take on part-time work or consulting in their early retirement years, which can reduce how much they need to withdraw from savings, and maybe let their investments keep growing a bit more. If you have a hobby or skill that can generate income, even better. Imagine getting paid a little for something you love doing anyway. Rental properties or income from investments like dividends are another avenue. The idea is multiple streams can add stability. If one source falls short, another can fill the gap. Lastly, don't forget estate planning as part of your retirement plan. While this might not help you during retirement, it's a smart financial decision for securing your family's future and ensuring your wishes are followed. Make sure you have a will and consider setting up powers of attorney and healthcare directives. If you have substantial assets, talk to an advisor about trusts or other tools to efficiently pass on your wealth. It all ties together. A great retirement plan not only covers living well in retirement, but also leaves a legacy in the way you intend. Key takeaways for smart retirement planning. We've covered a lot of ground, so let's summarize some of the key takeaways. These are the smart financial moves that can help secure your future in retirement. Start early and save consistently. Time and compounding are your best friends. The sooner you begin saving for retirement, even in small amounts, the more your money can grow. If you're getting a late start, don't be discouraged. Contribute as much as you can now, and utilize catch-up contributions if you're over 50. Consistency is key. Have a retirement goal. Determine how much income you'll likely need in retirement. Consider the 70 to 80% of pre-retirement income guideline as a starting point and adjust for your personal plans. Knowing your target helps you stay motivated and on track. Maximize tax-advantaged retirement accounts. Contribute to your 401k, 403b, IRA, or other retirement plans. Grab the full employer match if you have one. That's essentially free money boosting your savings. For business owners or self-employed folks, use plans like SEP IRAs or solo 401ks to save aggressively with tax benefits. Invest wisely and diversify. Don't let your savings sit idle. Invest in a balanced portfolio that matches your time horizon and comfort with risk. Diversify across different assets to reduce risk. A mix of stocks, bonds, and perhaps other assets. Avoid putting too much in any single investment. Adjust your asset allocation as you age. Generally more growth assets when you're younger, more conservative assets as you approach retirement. Stay the course. Don't let emotions derail you. Market ups and downs are normal. Have a long-term plan and stick to it. Avoid panic selling during downturns or chasing fads during booms. Remember, it's time in the market, not timing the market, that builds wealth. If needed, get professional advice to help manage your strategy and keep you disciplined. Plan for rising costs and health needs. Factor in inflation. Your retirement plan should allow your income to grow over time. Be prepared for healthcare expenses, which can be significant. Use tools like HSAs and consider insurance options for health and long-term care. Plan for a retirement that could last 20 plus years and structure your withdrawals, like using a 4% rule guideline, so that you don't outlive your savings. Review and adjust regularly. Lastly, remember that retirement planning isn't a set it and forget it deal. Life changes and plans may need updating. Review your retirement plan at least annually or whenever you have major life changes, new job, marriage, selling a business, etc. Adjust contributions, investments, and goals as needed. Keeping an eye on your plan ensures you catch any shortfalls early and celebrate your progress along the way. These key steps, taken together, form a roadmap to retirement security. It might seem like a lot, but you can tackle them one by one. And of course, you don't have to do it alone. There are financial planners, like our team at Tellone Financial Services, who spend their days helping people navigate these decisions. The important thing is to take action and stay proactive. Every smart decision you make now is like a gift to your future self. Wrapping up the episode. As we come to the end of today's discussion on retirement planning, let's recap in plain language. Retirement planning is all about securing your future so you can enjoy the life you've envisioned after years of hard work. We talked about starting early to harness the magic of compound interest and why it's never truly too late to improve your situation. We emphasize knowing where you're headed, setting a retirement income goal, and using all the tools at your disposal, like retirement accounts and employer matches, to get there. We dove into investing wisely, spreading out your risks, and adjusting your strategy as you get closer to retirement. And we shone a light on often overlooked factors like inflation and healthcare that can make or break a retirement plan. Remember, retirement planning isn't just an abstract financial exercise. It's about your life goals and peace of mind. The money is just the means to support the lifestyle and security you want for yourself and your family. With thoughtful planning and a few smart decisions made consistently over time, you can take control of your retirement destiny. It's truly one of the greatest gifts you can give to your future self, the freedom to live your golden years on your own terms. If you feel overwhelmed, take a deep breath. You don't have to become a financial expert overnight. Just start with one step at a time. Maybe after hearing this, your next step is to increase your 401k contribution a bit, or to call a financial planner for a checkup on your strategy, or even just to sit down with your spouse or family and talk about retirement dreams and concerns. Each step will build momentum. All right, that's a wrap on our main topic for today. I hope you found this discussion helpful and empowering. You have the ability to secure your future with the choices you make today. And remember, you're not alone on this journey. There are resources and professionals ready to assist if you need guidance. At Tellone Financial Services, this is what we do every day. Help folks like you create a roadmap to financial security and a comfortable retirement. Thank you so much for tuning in to this episode of the Tellone Financial Podcast. We appreciate you taking the time to listen, and we hope you gained valuable insights to apply to your own financial life. If you enjoyed today's episode, please subscribe to the podcast so you won't miss future episodes. We have a lot more great topics coming up to help retirees, professionals, business owners, and anyone aiming for financial peace of mind. We also encourage you to share this podcast with friends or family who might benefit from a dose of financial wisdom. For more information and resources, visit us at deantellone.com. On our website, you'll find articles, tools, and information about how to reach our team if you have any questions, or if you'd like personalized guidance on your retirement planning or any other financial goals. We're here to help, whether you're just getting started or looking for ways to optimize your existing plan. Lastly, we love hearing from our listeners. If you have topics you'd like us to cover in future episodes or any feedback on the show, please reach out. You can connect with us through the website or on our social media channels. Your input helps us make the podcast even better and more relevant to you. Once again, thank you for listening. Together, let's make smart financial decisions so you can enjoy a secure and fulfilling future. Until next time, this is Dean Tellone, wishing you financial health and happiness. Have a great day, and we'll catch you in the next episode.